Another quiet summer day today led us to actually a small bounce in the markets. Is this the near-term bounce, right? Have we had enough of a near-term pullback? There was a pattern today that actually gives us good signs going forward from here that we saw today that we haven't seen for a while. So I'm going to break that down today. I'm also going to break down other relationships that we're seeing here and interesting patterns on the markets and how they might impact any kind of posture or expectations you have going forward for the S&P. And then we'll take a look at a stock that we had looked at before for a bearish trade, one of those high probability bearish trades, but has broken out to the upside today. And if there's a way we might be able to trade that to the upside now. So let's go ahead and get started. Today is Thursday, June the 13th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. One quick note before we get into the video. The sound for this segment of the video, there was an issue with it. It's improved for the rest of the video. So I tried to fix it as best as I can for this segment, but keep that in mind for a few more minutes here, and then it will get back to normal after that. All right, well, let's start off taking a look at the market forecast, as usual, on the S&P 500 first. And you can see, again, near-term line, another day below 50, but it's still above 20. So, yes, we had a little bit of a bounce today, up 0.4%. Again, another very small range, similar to yesterday's range, but just to the upside instead of to the downside. Very small range. Intermediate line now is crossed up above the market sentiment line. Near-term line, again, 2 days. We typically expect the near-term line to stay below 51 to 3 days when you're in a bullish move, like we currently, at least we're in the beginnings of what could be a bullish move. We're expecting it to be a bullish move. And so we'll see if tomorrow that near-term line bounces back up, what kind of day we would get. Now remember, 29, I mean, we're not out of, today is not a bounce, even if we might have closed above the high of the low day. That 2 day doesn't necessarily make a low day. But the reality, again, is, we need to get through this 2,900 area, 292.50 on SPY, before we really break out here to the upside. If you're looking at, ES, and again, remember for multiple reasons, including the getting through this volume node, getting above the volume band, so you can see it's at 292.47 right now. So if the equivalent on the futures contract is 29.19, we're in the volume node as we speak, so getting above 29.19 and a half would get you through. That's when you say, I mean, yes, there still is a little bit of a high up at 29.61, but very little volume in those areas. So it won't take much to break through those highs. It's going to take more to break through this area that we're in right now to get to that point. It won't take very much once we're above 29.20 to get through 29.60 with the lack of volume. So those are the areas to kind of watch for going back to the market forecast. Again, that would obviously get the intermediate line up above 80, above 90. We're expecting it to get above 80 and 90, just like we've seen before. And we're expecting a 1 to 3 month rally out of this. Get that market sentiment line back up into the reversal zone itself, and we'll see how long that lasts. And again, if and when the near-term line bounces back up above 50, we're looking for a 7 to 12 day move on that one. So until we see anything different than that, that's our expectations, based at least off of this one indicator. Of course, it's not the only indicator we look at, but that's what we're seeing here on the market forecast indicator. The momentum line came out of the reversal zone. Again, it doesn't really matter what it does to the upside, since we are currently bullish. What matters on the red line is how far down it goes. So we don't want it to get down below 50, or 5, excuse me. If it gets below 5, it's not a warning. I mean, it's not a, you can see here it produced a weak bearish move. Here it preceded the actual consolidation. So those are the kind of big, significant declines that leads to the weakness, right? You can see down over here, leads to the more protracted intermediate run. So that's what we're watching for now to the downside. It doesn't really matter what it does to the upside. If it gets above 80, great. It doesn't really have to. In fact, a lot of times it just stays in the middle, just like this. You can see it didn't get up above 80, it didn't drop below 20, really. It just kind of stayed mucked up in the middle, and that's very, very typical of an bullish intermediate rally. Here's your Dow Jones Industrial Average, looking exactly the same as the S&P. Your NASDAQ composite, which is not as bullish, but now your intermediate line is almost up above the market sentiment line. Near term line down a little bit more today. And then your Russell 2000, which had been previously a lot more bearish, right, underperforming. Well, today it had a 1% gain, so a big move today brought the momentum line again to extreme highs. So that's a good sign, and brought the near-term line back up to above 50, like we expect to see on the S&P and all the other major indexes. So even though it's still below its moving average, even though the intermediate line is still below 50, that's the kind of move we're expecting to see coming out of the other indexes as well, and pretty much has a will gives us a good idea that we could get a nice good rally into the weekend here, especially too because Fridays have been very bullish. If you look, on Twitter, people who track that kind of stuff, Fridays have been the most bullish day of the year. I think the last I saw was like 77% of the time, which is the highest number of any day of the week. We've been bullish this year. So now we might not get a drop in volatility because of anything that can happen trade wise over the weekend, but at least from the market forecast perspective, not knowing any of that data, it also kind of gives us suggests that we should have a pretty good close to the end of the week. All right, looks like we got the issue here fixed with the microphone. Before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. There's also one down below the video. That will notify you when these videos are posted. Hit the thumbs up icon down below the video too. That tells me two things. Number one, you got something out of the video. You liked it. Number two, you want us to do it again tomorrow. So quick way to give us feedback, you can click right now while you're watching the video. Also, comment down there on anything that stood out to you today. We do have an email list for marketscholars.com. There's a link popping out up there. Click on that link to subscribe to our list. Very easy way to do that. Follow me on Twitter for more content like this in between videos from day to day. I just posted over here. I just posted right before recording this video a tweet about the defensive sectors. So you check that out there. Again, you see my handle up there. And then finally, join our Market Outlook community that we've created on Facebook. As always, we also invite you to subscribe to our website at marketscholars.com. There's a way to do that. If you're watching this video on our blog, it's up here in the top right corner of your screen. Underneath Join Market Scholars, click this image. Very easy way. You can do it for free. That gives you the ability to participate in our Market Outlook forums here. The rest of our forums, as you can see up here for our classes, are for our premium subscribers, as well as our class schedule over here on the right. Also, we got a lot of, look at all the engagements we got here on Twitter, but that's still a lot less than the number of views that we had on the video. So, if you like the video and you want to engage, you want to see our stuff on social media, on Twitter and Facebook, you have to engage with it. The more you engage with it, the more Twitter will show you our stuff. So we make it really easy for you. Just click on this heart. It opens up this window, and you can like the Market Outlook tweet there. And then here you can click on the Facebook post. Their algorithm is worse. So you really have to engage with our stuff. The more you do, the more you're telling Facebook, I want to see their stuff from the group and from their pages. Otherwise, they won't show it to you. All right, a quick look at the long-term chart. As always, again, very small. Very small range. Not surprising after a very big range last week. So 156 point range last week, 35 point range this week. So we're looking at what 190, about almost a 95 average point range over the last 2 weeks. Just to kind of give you an idea of the average range in a weekly chart here. The average range right now is for SPX. Is 77 points. So even when you add on the 2 weeks and average them together, that's why this week is such a small week. It's we had such a big week the week before. So keep that in mind. If you look at it from a Hakenyashi standpoint, it looks great. And for that matter, next week's candle will also start, depending upon where we finish tomorrow, assuming we finish higher, we'll start off next week's candle with a really good bullish one too. So that's normal. I mean, we got the transition candle last week. We expect a trend to come out of this. It might not last 13, 17 weeks like we saw here, but if it lasts, 1 to 3 months, that's, which would be what, 4 to 12 weeks, 4 to 13 weeks roughly, then that would be normal, right? So here we are, and we're on week 1 of that right now as we speak. Now let's take a look at the 3 green arrow chart, and you see, okay, well, we got 3 green arrows. We still don't have a green line, so we're still not above That's why I always say the train hasn't left the station yet. We are getting closer though. You see the 8 days easily, but we're still above the 8 day. We're above everything. But the 8 and 17 are rising. The 30's not yet. The 8 is above the 30. The 17's almost there. That's your last step of crossing over, right? You get the 8 crossing over, you get the 17 crossing over, and then the 30 rolls over. So you get the 8 crossing over, 17 crossing over, and then we're on our trend. So, that's what we need to see right now, and we're just about there. Again, the train's getting a lot closer to leaving that station. Now let's look at the intraday chart. A little bit of a jump here at the very, very end of the day, but very small range. Just like yesterday, very small range, but this time a higher high and a higher low. Closing above yesterday's high and towards today's high, but that you can hardly call that a bullish close. It's a pretty darn neutral day. Very small range, very small volume. You see that 48 million. I mean, this is something. We're in the summer, right? This is, I guess, is what we get in the summertime. You can also see when you look at the volume 2, 48 million down there, but you look at the ATR 1.36 points, way below the average. In fact, if you take a look at the average, it's coming down, volume's coming back down, the ATR, relative ATR is coming down. Those are bullish patterns, and remember they can stay down for a while. And just because we didn't go up a lot, see, this is very similar over here. This was just an intermediate pullback. This was just an intermediate pullback. It wasn't a bear market. It wasn't a correction. It was just looks bigger because the rally was bigger. But we didn't jump up above 2% or even above 1.5%. We stayed just above 1 on this relative chart. That's normal for intermediate pullbacks. And now we're about to get back below 1 where we can stay for as long as that intermediate run lasts. Let's take a look at the volatility index. Again, the train will leave the station when this sucker gets below 90%, and we're not there yet. So keep that in mind. Volatility is still relatively high, which is telling us keep in mind that there still could be some near-term fluctuations here before we get above that 2920 level where we're ready to go, right? We're ready to go, whether it's 2920 on ES or on to the 292.50 on SPY. So to summarize, the markets had a nice little bounce today. I don't think this is, the bounce. We're not there yet, but we're continually getting a lot closer. And if the small cap index is any indication and how it performed today, then we can probably expect to see something similar tomorrow out of all the rest of them. A good close of the week, and a good close of the week will lead us into a near-term run through next week, and we'll see if that's the one that breaks us through the barrier that we need to get through to really take off on another multi-month intermediate run, and if that ends up being the case or not. So what do you think? Do you agree with that assessment or disagree? Now I want you to vote. Click that link right there. It opens up the poll, and then vote with either agree or disagree. If you click disagree, comment down below. What do you see different that you'd like to share with the rest of the audience here? That would suggest either you're more bullish than this, or that you're not bullish at all, and you're actually looking at this more as a kind of a bear trap, so to speak. So share your charts or whatever you see down in the comment section below. All right, now let's transition into what's driving price action today. And you can see it continues to be the relative weakness in the dollar, and equities are rising. Look at the gap being filled here by small caps versus large caps over the last couple of days. So it's a good sign for the markets when small caps lead the way higher here. We had a really good discussion on that in my portfolio management class today. Again, premium class on our site, but we talked about small caps and large caps, and looked at our position in our class account there relative to that discussion. So that's a good sign for the broad market as a whole. Again, if you're expecting a bullish market like we are over the next couple of months, you need to see small caps lead the way higher. You also see international stocks doing better. They've been lagging behind. They're still lagging, but they've been, they lagged today as you saw, but they're up on the day, and you can see all the relative risk off trades besides foreign bonds. Long-term bonds are down. High-yield bonds are now back up above long-term bonds. They've crossed over. Crude oil has been the big outlier to the downside, and crude oil really needs to get going back to the upside before we really get going again. Now, crude oil the correlation with crude oil has dropped down from what it was. It's fallen down below that 75% mark over the last 3 months. And that's actually normal. It spends a lot more time underneath 75% than it does above 75%. So it's not a bad thing necessarily, that the correlation, but it still is positive, which means for the most part, crude oil and stocks will typically go in the same direction. And if that's going to be the case, and we do expect stocks to go up, you need crude oil to go up too. So it needs to kind of bounce off of this higher low it's formed today and get through, this level, the relative level that it has on its own chart, which you can see here. If I take a look at its own daily chart, it'd be right above this 55, and that's the divergence that we're getting. In fact, you can see it better on the actual futures contract. But you see, we've had these clusters, but you also see lower lows with higher lows in the near-term line. So there is a bullish divergence on crude oil, and 55 is the target. So that would be your target for the divergence, and breaking above 55 would signal that bullish divergence transitioning into a bullish reversal, a trend reversal. So and would get back into this reversal zone and get back up to the upside. So we'll see if that ends up being the case. I don't think the broad market can rally without it. Interestingly enough, I saw a note of this on TV, and I verified it on other sites. The crude oil as a percentage of S&P 500 in 2008, it got to the point where it was the biggest sector in the S&P 500. Right before, right in the middle of 2008, when the crude oil was peaking like crazy, the energy sector as a percentage of the S&P was the biggest weighting sector. Now it's down to 5%, so it's at its low point that it usually ever is as a weighting in the S&P 500. So in terms of valuations, a lot of these energy companies are really, really low or cheap right now compared to the rest of the broad market, compared to where they've been in the past. Of course, the dollar index has a big issue with that. And if you take a look, something that really stood out to me too today, the Ichimoku cloud for the dollar index, we have broken below this span here, and you notice we've rallied back up to the bottom of it. So that can act as a resistance level, especially with the green line here dropping below the blue line inside of the span. But that can act as a resistance, and we'll see if it does, right? The dollar's had a nice little drop to the downside to get through the span. And if you take a look at its retracement levels here, and let's just make sure I snap these. There they are. Good, they're snapped. So if I come here to this decline and then to where we stopped, we might, the 38%, we're just a little bit underneath the 38% Fibonacci retracement. Assuming that this resistance holds, very good likelihood that we can break through this low point and move to the downside afterwards. And if you take a look, at the trend strength indicators that we also like to look at, and you look at the daily chart, you can see that it dipped. It's been above 50 for most of the day today, and was about below -1 for most of the day today too, just dipping a tad bit below there. So we'll kind of watch on that index, watch on those things to see, does this little breakdown and then return move, does that hold? Does that new resistance hold? And then we roll over and start, continue, because you notice we've had a lot of noise on the dollar pretty much through the most of 2019 so far. There's only been a couple of moves a couple of trending moves. This was one of them that didn't last very long when we tried to get above 98, and over here was another one when we came off a higher low and broke up to higher highs. And of course, that didn't last very long. It lasted even less. And then we've had the one bearish move that started the year in 2019, that started this year, that broke us down below those lows. And then we hit this 95 and immediately bounced. So, and that started the triangle that we're breaking below now too. So aside from those really small trending moves, it's been very noisy. For, again, if we start a bearish trend here, similar to this, but obviously it would be red on this part, but this kind of move to the downside, that will be bullish for stocks typically, and it will be bullish for commodity prices like crude oil And for that matter, probably also bullish for things like gold, even though that's more of a safe haven asset, but it would do well in a weak dollar environment and be very good for emerging markets. Emerging markets have been very noisy too. They've been very noisy too. They've had a couple of trending moves. First, they had a good move here when the dollar was bearish, right, at the beginning of the year. That one bearish move it had. Then it had this another small little bullish run, weak trend. But then it had this, when the dollar was breaking out above 98, it really put a lot of pressure on emerging markets. And now we'll see, it's that bearish trend is done according to the trend strength indicator. We're in a noisy period. We're back up above zero here, and a weak dollar will propel this to the upside as well. All right, now let's take a look at the sectors. And as I mentioned before, I tweeted out about the sectors here. I tweeted out that about the safe haven areas, right? And over the last 200 days, the safe haven areas have been the best performing. Staples, utilities, real estate have been the best performing areas out of all the sectors. And of course, energy, not surprising. This is of course relative to the S&P 500. The S&P is up about 1%. So add about another percent to some of these numbers, and add one to the downside here, because that's what you get actually here. You see the same idea here. The safe haven areas over the last 200 days. This is that same 200-day period. A lot of people talk about how they're kind of making a move to the upside. Well, the reality is they've already made their move to the upside. They've had a good run. Of course, the main reason why is because they hold their value during the declines. You see that the outperformance started during the decline, and they held, even though it fell down a little bit. It held up okay. And you can see, too, during the decline, it held its value. So that's the main reason why. And then when the markets go up, they go up, too. They might not go up the same, but they still go up. They still hold their value. Because they held their value so well, they go up from a higher starting point than everything else down here. And the same thing over here. So over the last 200 days, a period where the market's only up 1%, and we've had, quite a bit of volatility to show for it. Of course, by the time this comes off the table and this starts the 200-day period, we're going to start to get more of a bullish move. We'll start to see their outperformance start to pull back a little. But then you see here, and you see the rotation, the relative strength rotation of the safe haven areas going from these outperformance leading sectors. This is on the daily chart, mind you. But over the course of this little rally, they've been declining. They've been pulling back. And if we continue to rally, we would expect these to move into the lagging sector below the 100 relative strength line. So, again, are they on the rise, or have they already risen? And looks more and more like they've already made their move. And you can see they lagged behind today during the rise. Technology down a little too. The biggest loser in the technology sector. Let's come over here. Let's see, it'd be the public, and then let's just go here. Let's go to the S&P 500, and then we'll just go to the biggest losers today. And in terms of the technology sector, you can see the A&D, Visa, Fiserv, MasterCard down, ADSK down a little bit. So you can see some of the IT stocks that are down the most. And I remember that it wasn't down. It was down a smidgen, not very much. Healthcare was, Eli Lilly continuing to be down. That's a stock we looked at for a bearish trade recently. Alexion Pharmaceuticals, Pfizer, and some of these other healthcare companies as well weighing on the sector. You see on the other end of the spectrum, the energy sector finally having a little bit of a rally to the upside. So you see a lot of energies up here, a lot of communication services, Disney being the big winner in that space. And really that's, you got Viacom and other media companies as well, but that was your biggest winner is Disney. And then you also have discretionary. So you have a lot of discretionary companies here, retail companies doing well. On a day like today, American Airlines, and some industrials, in particular the airlines, kind of following up on. They've had a really good run for a few days. You can see like a stock like UAL breaking out today, breaking out pretty sharply to the upside today. So let's take a look at United and this little breakout it's had. You can see we're breaking through the Ichimoku span here that's a very good bullish breakout actually. And the green line is about to cross up above the blue line, also a bullish sign too. And we're below the red line over here, which is the current price displaced by 26 days. We're above the close on that day. So good trending sign, and as I showed you before too with the trend strength. On a weekly chart, we've got some room to, we still got some work to do, but on a daily chart, today's move is getting us, again, after having, a bearish trending move and a bullish trending move and a bearish trending move and a bullish trending move and a bearish trending move and seems like this is our bullish trending move a period of time that we go through now. So, and we'll see if this is the one that gets us up above 90 for that matter. Let's take a look at the Bollinger Bands. Probably won't be surprised to know that we are up above the upper Bollinger Band, and you can see why. Again, 90 is such an important level. If this stock breaks above 90, it'll have a little hiccup maybe at 92.5, but there is nothing up above there volume wise. That's all the volume we got. So very little volume up above this level to tell us. To hold us back. So we are in the upper half of the Bollinger Bandwidth. We cleared through this space, this kind of vacuum of volume in one day, essentially, getting up above the band. You can see the percent being not significantly. When you get significantly above the band, then you can see, by the time you trade, an option, for this, you probably wouldn't do September there because you'd be right around the 20 days. You'd be looking right around at that October. You'd look for like an iron condor delta neutral type trade, and you can see even with the ups and the downs, you finished pretty much right around the same area as we got over here. So you don't really like the big moves, the big spikes to the upside, and for that matter, we're not big fans of big spikes to the downside. You can see by the time we got to that expiration, to the downs and the ups, we hadn't moved very much either. But just to get above it like it is a good sign too from a broad market standpoint. Also, you probably won't be surprised to see that the DMI is finally now with this breakout today getting below 20. The negative line getting below 20. Positive line was already above 25. Let's take a look at its market forecast chart, and you see dark green shading, and you'll have a dark green line tomorrow because you see the moving average has gone from 82.79. Well, it's actually down to 82.76, so it'll still be yellow. Looks like it's dipped up a little bit there, but it'll still be yellow tomorrow, but probably only for one more day, depending upon how we hold this little breakout pattern. But that's going to be your bullish pattern there. And then finally, the 3 green arrow chart for United. You see 3 green arrows and a spike in volume. So good bullish sign. That's a sign that we could get a trend. We already saw the trend strength chart as well. In fact, if you look at the long-term chart, the 15 200-day crossovers, you see that we had crossed down, and you see we got right back above the 200-day, and then getting above both of them clearly today, and getting a golden cross again on these long-term moving averages. So there's opportunity for a trending move to come out of this sideways action that we've had for so long. Okay. So here's how we're going to make the trade. So we're going to we want to be bullish. We're going to buy this out of the money option at that 90 call option. Remember, that's where the resistance is. So we're going to spend $3 for that. If we never get above the resistance, or $315 for a contract. If it never gets above that resistance level, then we don't. Then we'll lose $315 there. But we've had a nice good bullish rally, and from a bullish standpoint, you can say, okay, well, if I were to sell 2 of these contracts at 82.5 is kind of the midpoint below this week's range, just to kind of show you what that looks like on the daily chart here, and especially on the Bollinger Bands, to get back down below 82.5. We have this big volume node. We have that level. We have to nullify the breakout essentially, and get back below this volume node for us to start losing on that. So what we'll do here is we will pay, and we'll get about $300. If I did 2 of those contracts, we'll get $300 for that. Now keep in mind, this is a short put. So depending upon what type of account you have, if you have a a retirement account like we do on this example, we have to spend $16,000 to put this trade on. But if you have a margin account, then all you need is $3,000 to put this trade on. So you put $3,000 in. We have the ability to cover the cost of that call option. And if the stock does rally up, you can see the potential reward between now and August 16th, so August 17th to now. Here, let's reset parameters on this. If it does make the type of trade that you expect it would, that it could make, here, give me 1 second here. Then by the time, even if it is, so let's do a 1 standard deviation move. If it gets up to 100, then you've got, for that $3,000 of risk, you got $1,000 of reward potentially. Remember, you have the whatever you get on the call option itself plus what you made those two puts. So you make the $300 essentially, and then you make whatever you make on the call option for the $3,000. And if it does go down, then you can see our cost is covered all the way down to 82.5. And then you can say, okay, well, I would have lost $315 if it didn't go up. How far down can we go? So without, we can go down to about this area here, so about 80.5, before we lose the equivalent amount of money that we would have lost if we, anywhere if we don't close above 90. With the cost of the call option. So it's a way to cover the cost by doing a short put spread here, but that gives us the ability to flatten that area out, and give us some money while we're trying to get the stock up to $82.50 or $90. And if it does break out above $90, I've got my call option and I've got the extra return that I'll be getting from the short put. And by instead of putting just $300 into the trade, by putting $3,000 into the trade, it allows me to be a little bit more flexible with that money. It's for us to lose $3,000, it'd have to go all the way down into here. So I've got some room to work with to the downside. I can lose more than 315, but we'd have to really get down. We'd have to get through the value area now to the downside. And remember, we've got all the bullish breakout signals, including the 3 green arrows and the spike in volume, that would suggest we're more likely to break above 90 than we are to break below 80. All right, and that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link right there to go to our Market Outlook forums on marketscholars.com. And let's keep the conversation going. So open up any new threads with any questions or comments you have about tonight's video. Remember, you can also reply to anybody else's threads as well. But let's keep that conversation going. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on the video down below. Follow me on Twitter for more content. Join our community on Facebook as well as on our website at marketscholars.com. Have a great rest of your evening, everybody. Let's go Warriors. Let's get that Game 7 on Father's Day, and we'll see you all tomorrow.